Well, good morning. I'm Jogendra Rana, and the topic of the day is insurance reforms. Insurance reforms. The insurance industry has witnessed major regulatory changes in 2024, such as revised surrender charges for life insurance, policy loans and partial withdrawals, wider choice of product add-ons, enhancing free look-in period, strict timelines for claim settlement, new customer information sheet, and revised expenses of management, among others. So while majority of the reforms have been customer-centric to make insurance more easy to understand, purchase and retain with India's total insurance penetration is still at only 3.7%, both life and non-life together, compared to the global 7%. So more reforms are likely to be key to achieve a wider insurance net for the country, which is a stated objective of insurance regulator IRDAI. Industry leaders think to get an understanding of the reforms in the pipeline and the headwinds and tailwinds for this sector in 2025. The year 2024 brought in some landmark reforms that kept the industry on the high gear. So the sector showed agility, stepping up to meet all the deadlines issued by the regulator, while the full impact of these changes will unfold in the coming year. Near developments are poised to drive even more significant shifts in the near future. So with the life insurance penetration at a level of 3% in FY23 and life insurance density of $70 compared to the global average of $354, the tremendous opportunity waiting to be tapped is evident. So in this mix, the proposed increase in FDI limits could make it easier for newer players to enter the market. The composite license too stands out from a customer-centric perspective. It opens up more choices by enabling new players and distributors to offer a variety of products. So this mirrors global standards, encourages healthy competition, and ultimately works in favor of the customer and the industry alike. It is likely that the international players who want complete control will be more interested if 100% FDI is allowed. But having said that, India is a very different market. So any international player will have to spend a fair bit of time and effort to understand the local nuances to build a successful franchise. There will be a reasonably significant investment period, and the ROI, that is the return of investment, should not be compared to other developed markets for some period of time. Therefore, a strong domestic partner along with a reputed international player is always a good way forward. The proposal to allow insurers to distribute additional financial products such as mutual funds, loan, credit cards, and bank deposits, in addition to other value-added services, will open new avenues for revenue generation, positioning insurance companies as comprehensive financial service providers. For customers, this regulatory change will provide the convenience of accessing a range of financial products from a single institution simplifying their decision making process and creating more holistic financial solutions. Reducing the minimum capital requirement from rupees 100 crore to rupees 50 crore lowers entry barriers, encouraging the establishments of specialized or niche insurance providers. This change could lead to a more diverse range of insurance products tailored to specific market segments, enhancing customer choice. There may be financial and operational savings if insurers are permitted to provide several insurance classes under a single license. A one-stop shop for all insurance requirements could simplify the experience of customers. As far as headwinds are concerned, the geopolitical crises have led to increased market volatility and disrupted supply chains, creating considerable risk that insurers must navigate. So, in this context, the development of innovative insurance solutions becomes imperative to address these evolving threats effectively. Additionally, climate change and the frequency of catastrophic events have emerged as a major headwind. Economic fluctuations and persistent inflation presents another set of challenges. The affordability of insurance products could be at risk, especially in India's price-sensitive market, where enhancing penetration and having growth hinges on making insurance more accessible to a broader attitudes. The talent acquisition and retention and bridging the skill gap would also be crucial to the industry's future success. Cybersecurity risks and the unknown elements in that presents a key threat for the industry, which is concerned around data. With greater digitization and integration, there is much more risk that the industry is exposed to. On the other hand, tailwinds says the insurance industry has witnessed major regulatory changes in 2024, such as revised surrender changes for life insurance policy loans and partial withdrawal, wider choice of product add-ons, enhancing free look in periodistic timelines for claim settlement, new customer information sheet and revised expenses of management, among others. So while majority of the reforms have been customer-centric to make insurance more easy to understand, purchase and retain, with India's total insurance penetration still at only 3.7%, both life and non-life together. So compared to the global 7%, more reforms are likely to be key to achieve a wider insurance net for the country, which is a stated objective of insurance regulator IRDAI. So the the insurance industry leaders to get an understanding of the reforms in the pipeline and the headwinds and tailwinds for the sector in 2025. The year 2024 brought in some landmark reforms that kept the industry on high gear. The sector showed agility, stepping up to meet all the deadlines issued by the regulator. While the full impact of these changes will unfold in the coming year, newer developments are poised to drive even more significant shifts in the near future. So with life insurance penetration at a lower level of 3% in that FY23 and the life insurance density of $70 compared to the global average of $354, the tremendous opportunity waiting to be tapped is evident. And this makes the proposed increase in FDI limit could make it easier for newer players to enter the market. The composite license too stands out from a customer-centric perspective. It opens up more choices by enabling new players and distributors to offer a variety of products. This mirrors global standards, encourages healthy competition, and ultimately works in favor of the customers and the industry alike. So it is likely that the international player who want complete control will be more interested if 100% FDI is allowed. But having said that, it is difficult because India is a different market. So reducing the minimum capital requirement from dollar or rupees 100 crore to 50 crore lowers entry barriers, encouraging the establishments of specialized or niche insurance products. The insurance sector is set for significant transformation in 2025, driven by broad-based health insurance reforms, strong measures to boost life insurance penetration, digital advancements, and the implementation of stricter corporate governance norms. These developments are laying the groundwork for the next phase of growth, with the industry set to address new challenges and seize emerging opportunities. In 2025, the industry is expected to continue adapting to these reforms, focusing on ironing out challenges and capitalizing on new opportunities. So the long-term vision of insurance for all by 2047 is guiding the industry towards greater inclusivity and coverage. As reforms take root, the industry aims to improve both customer experience and service standards, benefiting all stakeholders involved. At the policy level, several key initiatives are expected to fuel growth. The proposal for 100% foreign direct investment in the insurance sector is seen as a potential catalyst for capital infusion, innovation, and enhanced service standards. The introduction of composite products combining multiple types of coverage into a single offering and the full rollout of the Bima Trinity initiatives, which aims to simplify insurance offerings, are also expected to play a significant role in expanding market accesses. Additionally, there are discussions about the possible exemptions on GST on health insurance premiums, which could reduce the cost burden for consumers. So technology will play an increasingly important role in the future of insurance, with embedded insurance emerging as a powerful growth driver. By integrating insurance products seamlessly into non-insurance services, insurers can enhance accessibility and convenience for customers. A strategic partnership with sectors such as automotive, real estate, and healthcare will enable insurers to tap into real-time data, ensuring that coverage meets the immediate needs of customers. So the adoption of artificial intelligence will also revolutionize the insurance landscape. AI-powered solutions are set to automate processes and offer real-time personalized experiences. By analyzing individual customers' need and context, AI will provide tailored protection, making insurance a seamless part of everyday life. This shift will redefine how consumers interact with insurance, offering a frictionless experience and integrates smoothly into daily routines. With these transformative reforms, the IRDAI has underscored its commitment to sustained growth and the vision of insurance for all. The focus on ease of doing business and removing barriers for both insurers and consumers is expected to lead to structural changes in the industry. So while these reforms present significant growth opportunities, industry experts caution that the increased foreign investment may introduce complexities. Navigating domestic and international regulations, managing market saturations, and addressing the need of local consumers could pose challenges. Without careful oversight, there is a risk of market imbalance and monopolistic tendencies. Therefore, a robust regulatory framework will be essential to ensure fair competition and protect the interest of local players. A key development in 2024 was the removal of the upper age limit for senior citizens in health insurance policies. effective from April 1, 2024. This move by the Insurance Regulatory and Development Authority of India has expanded access to health insurance for individuals above 65 years of age, enabling them to purchase health products for existing medical conditions. So previously, senior citizens faced difficulties due to escalating medical inflation and restrictive age caps. The regulatory changes has removed this barrier, providing a broader safety net for an aging population. In addition, the life insurance sector witnessed a transformative shift with the introduction of new surrender value and exit payout norms. These measures, which came into effect in June 2024, guarantee better exit payouts for policyholders who are unwilling to unable to continue paying premiums. This reform aims to make life insurance more accessible and customer friendly, improving the financial security of policyholders even if they choose to exit the policy early. The general insurance sector has also seen growth, with the gross direct premium income rising by approximately 11.2% compared to the previous year. This increase is largely driven by the health insurance segment, which experienced a surge in the premium due to growing health awareness. So the state insurance plan has also shown promising results, contributing to the overall positive growth in the sector. Thank you very much.